Good afternoon, everyone. Welcome to the class on investment management. So we were discussing about the differences of how we can work on investment strategy. While discussing on how we can work on investment strategy, we have studied about efficient market hypothesis. So according to the efficient market hypothesis, no fund manager, no investors, no active or passive investor in by applying any form of portfolio creation can able to beat the market. So efficient market hypothesis is very important for your exam purpose also and for basic understanding purpose also, that we cannot beat the market. So as per the efficient market hypothesis, the market reflects everything. So the one of the very good example which supports the efficient market hypothesis was the CAPA model. So one of the that was CAPA model. CAPA model stand for Capital Asset Pricing Model. So for your exam purpose also, you'll definitely will get the problem on CAPA model. So when we talk about CAPA model, in CAPA model, if you want to calculate the risk on an asset, on a security, so the formula which help us to create to develop the equation to where we can calculate the risk on asset is equal to RF plus beta into RM minus RF. This was CAPA model where the RF was the risk-free rate of return. Beta is the market risk on the security. RM is the return on the market, and RF is the risk-free rate of return. So the expected return on security, I can say that is RF plus beta. In place of beta, I can write covariance between stock and market divided by the variance of market into RM minus RF. Okay, then going further, if you are discussing the expected return security, I can write this as this RF is plus RM minus F divide by the variance of divide by the variance of market. So, this into this into variance between security and the market. So here in CAPA model, so in CAPA model, this is the equation, how we can build the equation. So ultimately, when we are working on CAPA model, when we are working on CAPA model, we'll plot the graph between the return on the security with respect to the covariance between stock and market, and the intercept for that this line, the intercept of this line will be the RF, risk-free rate of return, and the in this line what you get, the slope of this line, the slope of this line, the slope of this line, the slope of this line. So the slope of this line will be RM minus RF divided by the variance of market. And this line what you get, we call this line as a SML. This line, we call this line as SML. SML stand for security market line. So in exam also, you will get a question where they'll ask you what is SML, how SML is different from CML, so capital market line. So how capital market line is different from the security market line. So security market line basically basically consider the efficient market hypothesis logic, where according to the efficient market hypothesis logic, we can never able to beat the market. So the return, what we get from that return is the best return, and every fund manager try their best so that they can somehow reach the SML. So we believe that the all the fairly valued security lies on the SML. Okay. So any security which return lies above SML, so any security whose return can lies above SML, any securities whose return lies above SML, we call those securities as a undervalued securities. So any securities whose return is more than the CAPM return, so we call those securities as a undervalued securities. So every fund manager, by applying fundamental analysis and technical analysis, try to identify this undervalued securities only. So in previous, I think 6, 7 classes, we were discussing about how we can beat the market. So that is the ultimate objective of every fund manager. So either you are active investor or either you are passive investor. What you try to do ultimately your objective would be to beat the market. So fundamental analysts who follow fundamental analysis, they apply the logics of fundamentals, where they try to determine the intrinsic value of the stock. So they follow a dividend discount model, or they follow Gordon model or Walton model. So they read the balance sheet of the company, profit and loss statement of the company, cash flow statement of the company, fund flow statement of the company, work on different forms of ratios like P, price earning ratio, price to book value ratio, so price to sales ratio. So working on all these ratios and reading all these statements, ultimately what a fundamental analyst will try to do, a fundamental analyst is try to create such portfolio or try to search those assets which are undervalued stock, which have the potential to beat the market. And in reality, by carefully working on the logics of fundamentals and technicals, we can actually beat the market. That is the whole agenda of a fundamental analyst. While a technical analyst look into the price and volume data of the historical values of the stock, and based upon that, a technical analyst try to create a pattern or chart, or try to study the waves created by the price or volume data to predict the next movement. And in order to do so, he or she, a technical analyst, follow different mathematical models on oscillators and indicators to identify the trend uptrend or downtrend, and to create an possibility of support and resistance, which can ultimately help a fundamental analyst to identify those undervalued stock. And ultimately, what are undervalued stock? Undervalued stocks are altogether such kind of stocks which have the potential to beat the market. So here, like if we see numerical which came in exam, you can see this numerical. So which came in exam. So you can see this question. So here in this question, you have to do this only, that assume that you are a fund manager, assume that you are a portfolio manager. Based on the following detail, determine the securities that are underpriced and those are overpriced or underpriced in term of SML. So for this problem, what we do, we calculate the return of the security, we calculate the return of the securities, and we compare the return of the securities with the CAPM return. If the return on security is more than the CAPM return, then the particular stock is undervalued stock or underpriced stock. And if the stock return is less than the CAPM return, then that stock is overpriced stock. So all the undervalued stock lies above the SML, and all the overpriced stocks or are overvalued stocks. So all the overvalued stocks or securities, they lies below the SML. So this we need to understand. So basically, this SML is being created through CAPM return values. So CAPM model, we create this value. So the expected return on security is RF plus RM minus RF by variance of market into covariance between stock and market. Those who understand basic mathematics, they can understand. So ultimately, they are in this equation y equal to a plus bx. So every straight line follow this equation. So where your y coordinate is the return on security, and your x coordinate is the covariance between stock and market, and then your intercept is RF. RF means risk-free rate of return, and your slope of the line what you get gradient, that is called tan theta. So the angle what this line makes with the positive value of x-axis, so the in anti-clockwise direction. So the angle what this line is making, so that line we call the slope, and that is the slope of the SML, security market line. So when we follow CAPA model, in CAPA model we believe that all the risk can be put all together into a single factor, which is called as beta. So CAPA model is also called as single factor risk model. So many time, many analysts, they say CAPA model as a single factor. It is a single, it is a single risk factor model. It is a single risk factor model. It is single risk factor model. So basically, when we talk about CAPA model, we are discussing about a well diversified portfolio. So in a well diversified portfolio, there is no possibility of unsystematic risk, because the risk which a security have, it can be systematic or it can be unsystematic. So the unsystematic risk we can minimize by following portfolio. So when we create portfolios by choosing those stocks for which the coefficient of correlation is negative, we are not trying to choose those stocks which have positive coefficient of correlation. We are trying to choose those stocks which have a negative coefficient of correlation. So automatically, what will happen? So the ultimately, when we try to create a portfolio, then the effect of the variance, which is the risk of a security, single security, that factor will reduce, but a new form of risk will emerge, which is called covariance between the two security. But this covariance between the two security also can be minimized, possibly if we choose those stocks which are negatively correlated. In that case, if we are trying to choose those stocks which are positively correlated, then the logic of portfolio creation and the logic of minimizing the unsystematic risk will not work. So so if we are trying to minimize the unsystematic risk, so the unsystematic risk can be minimized. Unsystematic risk can be minimized. So unsystematic risk can be minimized. This is unsystematic risk. So unsystematic risk can be minimized by creating portfolio. So there is some form of risk which can never be minimized, which is called a systematic risk. So systematic risk is always there in the stock, and the factor which measures the systematic risk on the stock, that factor is called as beta. So beta consider all the systematic risk all together into a single factor. So which what we study under CAPA model. So this is what CAPA model is all about. But many analysts believe that CAPA model altogether does not consider the all forms of risk what in security can have. So we need to differentiate the risk also, systematic factor risk also what we have. We cannot put all of the risk all together into single factor called beta. So instead of putting all the risk into single factor called beta, we need to classify the risk into different heads. Each risk have different risk coefficients, so we cannot put all of them together into one factor. So as per the arbitrage pricing model, so each risk have the different risk factor, and then each risk factor what we have, that should be represented by different beta values, so that which is called a risk coefficient value. And then possibly we should study the return on the market. So as per the arbitrage pricing model, so the return on a security is equal to RF plus beta 1 into risk premium 1 plus beta 2 into risk premium 2, like that. So here, in arbitrage pricing model, we are not putting all the risk into all together into one factor. So here, instead of that, we are characterizing the risk into different types, and each risk have their own risk coefficients, and that we multiply with its risk premium, and then sum total of that when is added to the RF, that gives the return on the security. So that gives the return on the security. So this is arbitrage pricing model. It is an alternative to the capital pricing model. So where the capital pricing model put all the risk into one factor, arbitrage pricing model does not do like that. So it was developed by economist Stephen Ross in the 1970s, and over the year, the arbitrage pricing model the is more over the it's grown in popularity for relatively simple assumptions. So that is what is important for us. As for exam purpose, so last year this question came that what was the assumptions of arbitrage pricing model. So this question came last year that what are the assumptions of arbitrage pricing model. So you can see the question number 5A, 2 marks, mention any two assumptions of arbitrage pricing model. So the last year this question came. So we'll discuss this question. So arbitrage pricing model, it works on the fulfillment of drawbacks of capital asset pricing model, and that's why it get more and more popularity. Although arbitrage pricing model mathematically look little bit complicated, but yeah, at the same time, it holds much more important for the simple reason that it try to remove all the drawbacks of CAPM model, where in the case of CAPM model, we consider all the risk into single factor. So these you can see are the basic assumptions of arbitrage pricing model. So you can read by yourself. I think it's there in your screen. So when we talk about when we are discussing about arbitrage pricing model, so when we are discussing the arbitrage pricing model, it works on the assumption that the asset returns are explained by the systematic factors, and the investors can build a portfolio of assets where the specific risk is eliminated through diversification, and no arbitrage opportunity exists among the well diversified portfolio. If any arbitrage opportunity do exist, they will be exploited away by the investor. That's why we call this as arbitrage pricing model. So please understand that as so here, so as per the arbitrage pricing model, so the one of the assumptions of arbitrage pricing model is that the asset returns are well explained by the systematic factors. So because we are discussing about a well diversified portfolio, so here there is no consideration of unsystematic risk. So we so there the possible risk what we can identify here are basically the systematic risks. Okay, and where when an investor build their portfolios of assets, so there we there by diversification we have minimized, we have removed the unsystematic risk. Now the only possible risk which exists are the systematic risk, and for that systematic risk what we have, we can have different component of the risk factors, and by multiplying these component of risk factors with the risk premium, ultimately we then adding with the risk free rate of return, we can get the expected return on the security, and that should be identical in different market, and there should not be any possibility of arbitration. So basically, see, understand what is arbitration. Arbitration is all about earning risk-free profit in the market. So when we say arbitration, what is basically an arbitration? Arbitration is basically it is a strategy. When we talk about arbitration, it is basically is a strategy through which we can earn a risk-free return in the market. So that is what arbitration is all about. So by as what is arbitrage pricing model is saying that arbitrage pricing model is saying that you cannot think about implying any forms of arbitration by buying and selling simultaneously in two different market, because right now we are living in the world of high frequency trading, all algorithmic trading. So in this world of algorithmic trading or high frequency trading, so this possibility of arbitration exists for nanoseconds, and for that nanoseconds, those people who do block trading, those who trade in bulks, they try to get opportunity of the such kind of scenarios, and that they thereby the this possibility of working on arbitration does not exist. So when we talked about when we talked about arbitration pricing model, you can see this is the formula of the return on the security, that is RF plus beta 1 into F1 plus beta 2 into F2 till then beta n into Fn. So where the beta is basically the beta 1, beta 2, beta 3. They are basically the risk factors. They are basically the systematic risk factors of different forms of risk. Different forms of risk, like if I talk about a currency movement, if I'm talking about suppose if I'm talking about a currency movement, like suppose what is $1 is equal to suppose 75 rupees. So if I talk about what would be the return if I invest my money in dollar rupee contracts, what would my return? So here what I need to understand, RF, so we know RF, there's no problem with RF. RF is the risk-free rate of return. To identify RF, we simply have to look for the return what the treasury bills or government securities offers. So because in India everyone can default, but government of India can never default. So the returns which is offered by government of India is considered as RF. Now, what are beta 1, beta 2, beta 3? Those are the risk coefficient associated with the different risk. So if I'm considering this situation, suppose if I'm considering this situation for an example, suppose $1 is equal to 75 rupees. Okay, so if I want to see like for a dollar rupee contract, so for a dollar rupee contract, if I see this is a dollar rupee contract, suppose this is dollar rupee contract. So for a dollar rupee contract, you know that currency always trade in pairs. So what kind of risk it can have? The risk can be the inflation rate differential between the two countries. So the risk can be the inflation rate differential between the two countries. The risk can be the interest rate differential between the two countries. The risk can be interest rate differential between the two countries. The risk can be the GDP differential rate of GDP differential between the two countries. GDP differential between the two countries. The risk can be political uh, risk factor political risk factors between the two countries, the political risk factor differential between two countries. Then the risk can be many more variables, because currency altogether represent an economy, and a currency always trade in pairs. So then for each risk factor, you need to have a different form of beta. Suppose beta 1 basically talks about the inflation rate differential between the two economy. Suppose beta 2 here talks about the interest rate differential between the two economy. Beta 3 suppose talks about the GDP deflator between the two economies. The beta 4 suppose talks about the political risk factor differential between the two economy. And then by adding this with the RF, ultimately we get the expected return on the security. So here we need to understand that arbitrage pricing model, which was developed by Stephen Ross, can actually talks about the reality of the market, because we cannot put this interest rate differential or inflation rate differential or GDP deflator or political risk differential or trade barrier differentials or whatever different forms of risk. We cannot put all of them together into one factor. So that is what the arbitrage pricing model basically talks about. So you can see that so risk, when you talk about risk can be microeconomic risk can be macroeconomic risk. So microeconomic risk, although we can minimize by following portfolio, by working on diversification, but macroeconomic risk, it is very difficult to minimize. So this is what arbitrage pricing model basically discuss with us. So this we need to do when we work on arbitrage pricing model. We try to estimate the factor sensitivities, and then we try to calculate their factor premium. So the factor sensitivity here basically means the beta of each risk factor, and factor premium basically means RM minus RF. So for that you what you need to understand here. So as you know that when we are discussing the CAPM model, we calculated the beta of the stock, where the beta of the stock basically measure the sensitiveness of the stock with respect to the market. Like the same way here for each risk, we try to measure the sensitiveness of that each risk factor with respect to the sensitiveness of the market. And then it is very easy. It is very easy. If we get the data, calculation of beta is very easy. We just need the regression slow formula of the regression. So with that, we can easily calculate the beta. So that how the beta actually help us. So the two variables you need to consider for the beta: one should be a dependent variable, other should be independent variable. So then we just need to calculate the formula. So the formula for the beta, if you remember, so the formula of beta is n summation of xy minus summation of x into summation of y divided by n summation of x square minus summation of x whole square, where x is the independent variable and y here is the dependent variable. So we just need historical data of these values. If we get the historical data of these values, we can easily calculate the risk sensitivity, factor sensitiveness, which we called as a beta of each factor, and then we just need to multiply with the Rm minus Rf. So Rm minus Rf, that will remain constant only. So it is very easy obtain betas and all. We just need to use regression. We just need to use regression model for that. So and then we need to simply multiply that with the risk premium. So this arbitrary possibilities, when we work on arbitrage possibility, so the ultimate objective here is that we need to create a model which altogether can consider the different forms of systematic risk, uh, which a model can suffer or which can support. So an arbitrage pricing model as an alternate model to the capital asset pricing model, it tries to explain that the assets or the portfolio returns with the systematic factors and the portfolio or asset sensitiveness to these factors. So this theory basically explains the expected return of a well-diversified portfolio with an underlying assumption that the portfolios are well diversified, and any discrepancy from the equilibrium price in the market would be instantaneously driven away by the investor, because they can understand the possibility of arbitration, and any difference between actual return and expected return is explained by this factors of price. So here when we if you're trying to solve here if you're trying to solve the problem here if you're trying to solve the problem here, we can get such kind of portfolio which can actually able to beat the market, because CAPA model altogether can have lot of drawbacks, and that's why it's easy to identify the undervalued stock as per the CAPA model. But working on the similar model, and by working on the similar factors, mathematical factors, by applying the arbitrage pricing model, to create the possibility of arbitration, or to identify a value stock where we can actually get the return more than the market is little bit difficult to work on. So there, although the drawback of arbitrage pricing model is that it does not specify the systematic factors, but analysts can find that these by the regressing historical portfolio returns against the factors like GDP, real GDP, growth rate, inflation changes, term interest rate changes, or risk premium changes, and so on. So the regression, if we can use regression models, and if we can imply the different regression equations, it is possible to access these different systematic factors, which can altogether help us to calculate the portfolio returns, which may not be very easy to work on by using the CAPM model. So when we talk about CAPM model, they have their own advantages. They can have their own disadvantages. So CAPM model, it looks easy. It looks easy. It looks more defined. It looks more easy to calculate. But again, CAPM model have their own disadvantages, like and just understanding the calculation of RF, determining the value of RF, then the return on the market, considering that the all the risk altogether is put into a single factor, and the return of market, we believe, considering that the Nifty is the best benchmark which can represent a market. That is again is not in a very ideal situation, because if I'm talking about a stock, if I'm trying to analyze in stock, which is a small cap company, so it does not have much relation with the Nifty, because Nifty altogether is a portfolio of 50 blue chips company, and maybe my stock is a small cap company. So instead of looking into Nifty, I should better consider a better benchmark, better than Nifty. Maybe there's an index BSE 500, or maybe BSE 100. So that way, I believe that way I could have a better representative of which can be claimed as a market, and for which I can use in the CAPA model the return on the market. So then the other drawback of the CAPA model is the ability to borrow at the risk-free rate. So CAPA model is built on the major assumption that reflects an unrealistic real-world picture. This assumption that the investor can borrow and lend at the risk-free rate, which is far away from the reality, because CAPA model believes that the investors can borrow and lend at the RF, but in reality you cannot borrow or lend at the RF, because ultimately every individuals have the different risk factors. Every company have the different risk factors, and you have a CIBIL, you have credit rating agencies who assign credit ratings, and based upon that, borrowing and lending is possible by either a company or individuals. So the possible assumptions of CAPA model, where we believe that the borrowing and lending can be done at RF, is again unrealistic to work on. Then the determination of project of proxy beta. So beta altogether, when we talk about beta, beta altogether talks about the sensitiveness of the stock with respect to the market. So here, when we're trying to understand the sensitiveness, here we need such data which should be available in public domain to calculate the beta to work on the regression model. But we need to understand one thing: there are a lot of private based companies are there who actually don't actually publish their data. So for a private company, there's no listing on the stock market. If there's no listing on the stock market, so there's no historical data. If there's no historical data, then the calculation of beta altogether is not at all possible. And then establishing this regression relationship, or to measure the sensitiveness of the return of the stock with respect to the benchmark return, altogether will be a questionable task to work on. So again, either we talk about a CAPA model, or either we talk about arbitrage pricing model, they have their own advantages and they have their own disadvantages. But yeah, you should be aware about arbitrage pricing model. Tomorrow we'll do this numerical, just what you can see on the screen. Okay. So anyone have any doubt? Any question you want to ask anyone? Anyone want to ask anything?